You put $1,000 in your savings account. A year later, you check the balance. You've earned $4. $4. You could find that in your couch. Meanwhile, your bank just posted record profits. Again. And somewhere in a boardroom, someone is very quietly celebrating the fact that you don't understand how this works. Because here's what they won't tell you. Your savings account isn't designed to help you save. It's designed to help them lend. Let me show you the machine. When you deposit money, you think it just sits there, safe, boring, yours. But the moment that cash hits your account, it stops being idle. Your bank takes that $1,000 and immediately does something with it. They lend it out to someone buying a house, to a business expanding, to a credit card holder who missed a payment. And here's the beautiful part for them. They lend your $1,000 at 5%, 6%, sometimes 20% interest, but they pay you 0.4%. You're not a customer, you're inventory. This isn't some conspiracy, it's just math with a markup. The difference between what they pay you and what they charge borrowers is called the net interest margin, and it's how banks make the majority of their money. Last year, the biggest banks in America pulled in over $100 billion in net interest income. Not from fees, not from investments, from the spread. From your money sitting in their vault, working overtime for them while paying you in pocket change. Now you might be thinking, fine, but at least my money is safe. And it is. The FDIC guarantees it. But safe and profitable are not the same thing, because while your savings account crawls, inflation runs. Over the past 3 years, inflation averaged around 4% annually. Your savings account paid less than 1%, which means in real terms, you didn't preserve your wealth, you watched it shrink, slowly, politely, with a monthly statement. The system depends on you not doing this math. It also depends on something else, your inertia. Switching banks is annoying. Reading the fine print on high-yield accounts takes effort, and most people simply don't. They open a savings account at 18 and keep it until they're 40. The bank knows this. They count on it, because if everyone moved their money to the highest available rate tomorrow, the whole model would crack. But they won't, so it doesn't. Here's where it gets darker. Right now, the Federal Reserve has interest rates sitting above 5%. That means banks can park their reserves at the Fed and earn 5% risk-free. But your savings account, still getting crumbs. They're literally earning more on your deposits by doing nothing than they're paying you to store them. It's not illegal, it's just efficient. And this is the part that should bother you. The system isn't broken, it's working exactly as designed. You were never supposed to get rich off a savings account. You were supposed to feel safe, stay put, and fund the lending machine. The interest rate you see advertised in giant font at the bank branch, that's not a gift, it's rent. Rent on your own money. So what do? Move to a high-yield savings account and claw back 2 or 3 extra percent? Sure, but even that's just rearranging deck chairs. The real game is elsewhere, in assets that grow faster than inflation, in investments the banks themselves are making with the billions they're earning off deposits like yours. But most people won't do that either, because the savings account feels safe, and safe feels like enough. Which raises the question nobody wants to answer. If your money isn't actually growing, what exactly are you saving it for?